Hi everyone, welcome back to Corporate Decoder. Today we're cracking open Diameter Credit Company's latest filing. Think of it as peeking under the hood of a credit-focused investment firm. But don't worry, I'll be the translator. Get ready for some numbers that, well, let's just say they might make your eyes glaze over if you're not careful. But fear not, I'm here to make it interesting. Diameter Credit Company, they chose to be regulated as a business development company, or BDC, which basically means they invest in developing or struggling businesses. They want to make money by lending directly to these companies, mainly middle market and upper middle market ones. Think businesses making between $25 million and $25 million in profit. The main point is their plan to make money investing leverage and debts. That's what we'll be looking at. There are also rules here about what assets they have to have. 70% of their assets must be what the SEC calls qualifying. Most of those qualifying assets are securities from firms that are in the United States and most often aren't traded on a national exchange. In other words, they have to invest in US-based smaller businesses. And then there's some stuff that seem restrictive about their business, but then they are exempted by the SEC. For example, we've got an SEC order that allows the company to co-invest with other Diameter-controlled funds. It all sounds complicated, but it basically boils down to allowing them to pool their money together. This part is important. There is currently no established public market. So how do investors get in? Well, they make commitments to purchase common shares through fancy contracts. Speaking of those contracts, they also note the severe economic consequences for defaulting shareholders. It sounds like they might get aggressive if investors don't cough up the cash. They intend to have around 90% of their investments in safer first line loans. But again, the most of this is a target. They can change any of these things at any moment. Now let's get into money. The management fees. If the annual management fee is about 1.25% of the average value of the company's gross assets. But hold up, the advisor is waiving some of this fee, so capital gains. Scroll to the main source of revenue would be capital gains fee, which is where the advisor makes 15% of your profit. So if your investments do well, the advisor does even better. However, this part of the incentive fees earned in prior years cannot be called back even if we later incur losses. Also, what's important to note in this paragraph is that following the 6-year anniversary of the effective date, and if no liquidity event has occurred, the company will cease retaining or instead distribute the proceeds to shareholders. Now let's talk about competition. They acknowledge they are up against bigger, richer players. To succeed, they will have to face commercial banks, other BDCs and investment funds, hedge funds, etc. The little guys are going to struggle with this. A lot of the risk factors here is that they are competing with other Diameter affiliates. Basically, the manager of this firm will have the ability to decide to give the best investments to other firms, and there is little you can do about it. Speaking of little you can do, our board may amend our declaration of trust without prior shareholder approval. That means that major decisions can be made without you being able to voice your opinion. And there's also limits as to how much they can borrow. Basically, the law says that their assets have to be at least 150% higher than what they owe. In plain language, this is meant to protect investors. Interest rate volatility could adversely affect our results, particularly given that we use leverage as part of our investment strategy. The financial and operating results of our portfolio companies will be negatively impacted by rising interest rates. This is a fancy way of saying that if borrowing money becomes more expensive, the companies they invested in will have a harder time paying back. Because they are an emerging growth company, some of the rules are waived. For example, our management must prepare a report regarding its assessment of our internal control over financial reporting, starting with our annual report on Form 10-K for the fiscal year ending December 31, 2025, and a third-party check may not be required, meaning that material weaknesses or other deficiencies in our internal control over financial reporting go undetected. Indicate by checkmark whether the financial statements of the registrant included in the filing reflect the correction of an error to previously issued financial statements. No, which means that they're not admitting to messing up their finances before. The report notes the number of shares of registrants' common shares outstanding as of March 12, 2025 was 25,954. The report shares the effects of using leverage, which is a double-edged sword. If all goes well, it accelerates a profit. If not, your losses increase. Let me point to it. Check out how much returns change with debt. It could go from 10% to a whopping 30% loss on shareholder returns. Be careful. And here's the juicy stuff, actual performance. Large, accelerated filer, no. Accelerated filer, no. And the firm considers itself a non-accelerated filer. Non-accelerated filer basically means the company doesn't have to follow the rules for larger firms. Now, let's jump into the investment portfolio numbers. This section tells you what percent of the firm is constituted by each of the sections they are betting on. As of 2024, first lien debt represented over 93.8%, with much less being allocated to preferred and common equity. That means they mostly betting on loans. But this also tells you something. Most of their investment is in the United States, so if they have success, is tied to how well does the economy in the United States work. And then at the end, buried in the bottom of this text, we have a key piece of information. If the registrant has elected not to use the extended transition period for complying with any new or revised financial accounting standards. Okay, after all this information, they are still confident about this so-called risk factors. In fact, they mention, although we believe that the assumptions on which these forward-looking statements are based are reasonable, any of those assumptions could prove to be inaccurate. So things might not be as rosy as they paint. After all this information, what's my verdict? Diameter Credit Company is trying to position itself as a player in the middle market lending space. They are trying to use their connections to source deals and provide borrowers capital, all fine and dandy, but it's very important to note and be very careful of the conflicts that they have. They basically can, without your permission, give a better deal for others, and then what? You just face it. In short, there are lots of things to be careful and take in mind. Anyways, that's just my view. Hope you liked it. If you enjoyed, please subscribe, like and comment, and see you all soon.